Now we're going to talk about closing entries. I've listed out excuse me, the 4 steps of the closing entries right here. I'm not going to read those to you. You can read those on your own. The steps are similar but slightly different if you're dealing with a corporation, which is what our book usually deals with, versus a sole proprietorship, which is what we learned in Accounting 1 and 2. The first step we always have to do is to close out all of our revenue accounts. We have sales and we have rent income. Because those are credit balances, you have to debit those to close them out or to zero them out. So in either case, we're going to debit those 2 accounts, and for whatever the total is, if it's a corporation, we credit retained earnings. If it's a sole proprietorship, we credit income summary. The second entry is to close out all of our expense accounts. Those are debit balances, so to close them, we have to credit them. And if it's a corporation, we debit the total for retained earnings. If it's a sole proprietorship, we debit income summary for the total. The third entry only occurs if we have a sole proprietorship, and that is we would need to close out the income summary account. Because the income summary currently has a credit balance of $26,500, we will debit that account for $26,500 to eliminate it, and then we will credit the owner's capital account. And then finally, the last closing entry for both of these is to close out any dividends paid for a corporation or the owner's personal draws. So for corporation, we will debit retained earnings for the amount of the dividends, and we will zero out this dividend account. The dividends are going to have a debit balance, so we will credit them to zero them out. The drawing account has a debit balance, so we will credit it for $1,000 to close it out.